Close BP is to resume share buybacks after reporting a doubling in third-quarter profit, in the clearest sign yet that the oil company is confident about a turnaround. Silvia Antonioli reports. Video provided by Reuters News. Look, China's biggest oil and gas producer PetroChina debuted on the Shanghai Stock Exchange in November 2007, becoming the first $1 trillion company in the world. 10 years later, almost to the date, PetroChina's Shanghai-listed shares have dropped by a staggering 82% since the IPO, wiping out shareholder value of $800 billion, Bloomberg calculated. That's more than the current market capitalization of Microsoft, or the value of the entire Italian stock market, or the combined net worth of the world's 12 richest people, or Switzerland's GDP, take your pick. Since the end of 2007, several factors, domestic and international, have combined to contribute to the biggest individual stock slump in history. And if that isn't enough, analysts think that PetroChina's rout on the Shanghai Stock Exchange is not at the bottom yet. On PetroChina's first day of trading on the Shanghai Stock Exchange on November 5, 2007, its share price almost tripled its IPO price and took its market value beyond the $1 trillion mark, the first time a company had been valued at more than $1 trillion. But back then, cracks in the financial system had already started to emerge. The subprime mortgages market collapsed a few months later, Lehman Brothers filed for bankruptcy in September 2008, and the global financial crisis was in full swing. The markets hardly had time to recover before the oil price crash of 2014 hit, which has since wiped out a lot of profits and market capitalizations of all oil and gas companies around the world. Image source: Getty Images. After suffering more than 2 years of declining low oil and gas prices, the financial statements of energy companies have been absolutely ravaged. Cash flows have dried up, balance sheets have been ballooning up with debt, and more than a few companies have filed for Chapter 11 bankruptcy. Even the once impregnable dividends of the integrated majors have looked more troubled than they have in more than 30 years. Needless to say, in a cyclical industry like oil and gas, there are fortunes to be lost and fortunes to be made. The companies that can come out the other end of this major decline could have an immense opportunity to profit, as declining investment in the industry could easily bring supply and demand in line once again. With all of these key facts in mind, investors are likely to benefit from looking closely at the integrated majors. Their size, diversified business models, and propensity to pay a regular dividend in this boom and bust industry can make them intriguing prospects. As much as they are alike, though, there are enough subtle differences between them that investors should be aware of before diving in. Let's take a long look at these monolithic energy companies to determine which one is the best investment today. The usual suspects. Typically, the term big oil refers to companies that have a few distinctive traits. They have assets in every part of the oil and gas value chain. The production levels are measured in the millions of barrels per day, and their respective market capitalizations are huge. We're talking $100 billion or more. Based on these criteria, there are always 5 companies that are mentioned: ExxonMobil NYSE XOM, Chevron NYSE CVX, Royal Dutch Shell NYSE RDSA NYSE RDSB, BP NYSE BP, and Total NYSE TOT. For argument's sake, though, let's add one more integrated company into the mix: Italian oil producer Eni SPA NYSE. There are a couple other companies that we could add to this list, such as PetroChina and Petrobras, but they are a little harder to evaluate purely as investments because they have heavy investment from their national governments. In the best-case scenario, the interests of the state may not be 100% in line with those of the shareholder. At worst, financial reporting from the company may be deliberately opaque and not completely reflective of the situation on the ground. Eni does count the Italian government as a major investor, but it hasn't employed some of the heavy-handed policies that the Brazilian and Chinese governments have on Petrobras and PetroChina, respectively. There are the typical metrics to look at when evaluating these companies: margins, cash flow, returns, valuation, etc. But the current 2-year low in oil prices isn't exactly normal times. So in addition to the typical signs you want to see in these companies, let's also take a look at how they have responded to the decline and how it might impact their future. Margins and returns: company gross margin, current gross margin, 10-year AVG. EBITDA margin, current EBITDA margin, 10-year AVG. Net income margin, current net income margin, 10-year AVG. BP 14.6%, 15.7%, 8.4%, 10.9%, 2.8%, 3.5%, Chevron 30%, 30.5%, 14.1%, 18.2%, 0.7%, 8.2%, in any 17.7%, 26.3%, 12.3%, 22.4%, 20.2%, 2.5%, ExxonMobil 42.7%, 35.7%, 12.2%, 15.8%, 5.1%, 9%, Royal Dutch Shell 15.2%, 16.4%, 7.4%, 11.3%, 2.1%, 4.6%, total 33.6%, 32.7%, 14.9%, 18.3%, 2.5%, 6%, data source SP Global Market Intelligence. There is no way to look at these results without having to hold your nose, but then again, that is what is going to happen when oil prices steadily decline for more than 2 years. The past 12 months have been some of the most brutal for any company with exploration and production assets. While all of the companies here are integrated companies that have assets in production and refining, the fact of the matter is that all of them were generating the lion's share of their profits from production over the years. Some companies have fared better than others, though. As the table shows, both ExxonMobil and Total have managed to maintain positive net income margins over the trailing 12 months while the rest have dipped into the loss column. Total, in particular, has offset the declines in prices with a huge uptick in production from lower-cost sources such as its operation contract with the Abu Dhabi company for onshore oil operations ADCO. ExxonMobil, on the other hand, has mostly kept on doing what it has done for decades. It avoided some of the unprofitable pitfalls that others succumbed to because the price at which the company assessed new projects was much lower than the price its peers used. As recently as 2014, Chevron, Shell, and BP were building their capital budgets with oil around $70 a barrel, while ExxonMobil's budget was based on oil at $55 a barrel. Staying conservative then is clearly helping profits now. The other big outlier here is Eni's ghastly net income margin. I'm sure that management wants to chalk that up to the $4 billion in asset write-downs it took over the past 12 months, but that doesn't tell the whole story as the company's gross profit margins have declined the most in the group. Since asset write-downs aren't included in the gross margin calculation, clearly there were some cost issues that have hampered the company lately. Keep in mind, though, that profits don't always correlate with generating returns. So to double-check those profitability results, let's look at all of these companies on a return basis. Also, instead of being easy on them with a simple return on equity calculation, let's use the DuPont return on equity calculation to see if something fishy is hiding in those returns by breaking them down into their components and multiplying them together. This graphic describes the components. Data source SP Global Market Intelligence. Chart by author. It's hard to evaluate a company when its EBIT margins, that is, before interest and taxes, are negative using this method. It throws off metrics like interest burden and tax efficiency. So for now, let's just look at the two companies with positive pre-interest, pre-tax margins, ExxonMobil and Total. While ExxonMobil does a slightly better job of generating sales from its assets and is less burdened by interest, Total's higher EBIT margins and a little bit of tax relief gave the company a slightly better result. That's no small feat considering that ExxonMobil has been the leader of the pack in terms of return on equity for decades and even has a bit of an unfair advantage in this metric because it has bought back so much stock over the years that its book equity value is well below its market value. We can even double-check this win for Total with management rate of return. This is earnings before interest and tax, divided by total property, plant and equipment net of depreciation and total working capital. It's a more accurate measure of how effectively management allocates capital. Company management rate of return: BP 1.17%, Chevron 3.6%, Eni 4.14%, ExxonMobil 2.35%, Royal Dutch Shell 4.65%, Total 5.67%. Data source SP Global Market Intelligence. We can see pretty clearly here that Total has arguably done the best job at managing this downturn. ExxonMobil is in second place as it is the only company that has been able to maintain positive margins and returns recently. The one company that has done a surprising job on this end is BP. This time last year, the company was the worst performing of the group in terms of margins and returns, but that was in part because it was much more aggressive at writing down its assets and taking losses related to the litigation following its 2010 Gulf spill. With fewer write-downs and some pretty impressive cost-cutting measures, BP seems to be on the rebound. 1. Total Photo 2. ExxonMobil 3. BP 4. Chevron 5. Royal Dutch Shell 6. Eni. Apart from those international market events, PetroChina's Shanghai-listed shares also suffered from the 2015 Chinese market collapse, when excessive speculation in stocks led to an unsustainable bubble, which the government then suppressed with extraordinary measures and intervention on the stock market. This also wiped out some of the market value of the Shanghai shares of China's biggest oil producer. PetroChina is also listed in Hong Kong and New York. More recently, Chinese policies to boost electric vehicle EV use, turn to cleaner energy use, and prevent another stock market bubble from swelling by clamping down on speculative trades have further hurt PetroChina's shares and made analysts even more bearish on the stock's Shanghai market performance. In addition, PetroChina's stock is expensive in terms of forward price-to-earnings ratio. It trades at a much higher P ratio than its peers around the world. Why would anyone want to buy the stock when it's trading for more than 30 times earnings? Toshihiko Takamoto, a Singapore-based money manager at Asset Management One, which oversees about $800 million in Asia, told Bloomberg. PetroChina trades at a forward P ratio of 32, compared to Chevron's 25, Exxon's 22, BP's 18, or Sinopec's 13, for example. Close. Royal Dutch Shell reported a near 50% rise in quarterly profits, driven by strong refining, while solid cash generation underscored the oil and gas company has adapted well to a world of low oil price. Newslook analysts are also surprisingly pessimistic about the forward 12-month performance of PetroChina's Shanghai shares, expecting a 16% downside, while they are typically bullish on large caps. To compare, analysts expect shares in the blue-chip CSI 300 index to rise by some 10% 1 year from now. According to Bloomberg, not everything is bleak for PetroChina's shares. The ones traded in Hong Kong have better prospects. The latest price target by Hong Kong-based analyst at Jefferies, Laban Yu, suggests that the stock may gain 31% in the next 12 months. Moreover, the Chinese government, via China National Petroleum Corporation (CNPC), holds the controlling stake in PetroChina and some 12% of its shares are listed, which means that the actual impact on minority shareholders may not be as big as the market value loss would suggest. Nevertheless, the Chinese policy to curb speculative trading and its aggressive push into EVs adoption don't bode well for PetroChina's chances to offset most of the market value loss that its Shanghai stock has sustained over the past decade. Oilprice.com is a USA Today content partner offering energy industry news and commentary. Its content is produced independently of USA Today. More top reads from oilprice.com. Gasoline demand climbs to record highs. Oil prices soar as demand heats up. New U.S. sanctions threaten Russian oil projects. Reddit share this story https://usat.li2a7i7